Hey, welcome back to Next Millionaire. We've all heard of banks. They're essential to our daily lives, helping us store money, take out loans, manage investments, and make payments. But have you ever wondered how exactly they work? How do they make money? What do they actually do with your money? And most importantly, how do they manage to pay salaries to their employees and cover their operational costs? In today's video, we're going to break it all down, from the nuts and bolts of how banks operate, to the different ways they generate income, to the reality behind the scenes that most people don't know. Whether you have a savings account, a mortgage, or a credit card, this video will give you the insider knowledge you need to understand the hidden mechanics of the banking world. So, let's get started. Let's start at the very beginning. What exactly is a bank? Imagine this. You've just received your paycheck and you want to store it somewhere safe. You could keep it under your mattress, but that's risky and, let's be honest, pretty inconvenient. So, you decide to take it to the bank. A bank is essentially a safe place for you to store your money. But it's not just about keeping things safe. It's much more than that. Banks act as intermediaries in the financial system, meaning they connect people who have money, savers, with people who need money, borrowers. In exchange for holding your money, they offer services like savings accounts, credit cards, and loans. Now, there are different types of banks: commercial banks, investment banks, and central banks, and each has a different role. Most of us are familiar with commercial banks. These are the banks you see on every street corner, the ones where you open your checking or savings accounts. They offer services like lending money for mortgages, car loans, and personal loans. You might walk in, ask about getting a loan, and the bank will give you the money you need, usually with interest. Then, there are investment banks. These are the big players behind the scenes of the financial world. Investment banks help companies raise capital by issuing stocks and bonds, and they handle mergers and acquisitions. These banks don't usually deal with regular customers like you and me. They're more focused on corporate clients and big financial deals. And finally, we have central banks. These banks, like the Federal Reserve in the US or the Bank of England in the UK, don't deal with individuals or businesses directly. Instead, they regulate the entire banking system in a country. They make sure the economy stays stable by controlling things like interest rates, the money supply, and inflation. Now, let's address the big question. How do banks actually make money? It's not just about holding your money in a vault. The truth is, banks are profit-driven businesses, and they make their money in several ways. Let's break down the key income streams. 1. Interest on loans. This is the primary way banks generate income. When you deposit money into your savings or checking account, the bank doesn't just store it for you, they use it. Banks lend out a portion of the money deposited by customers to borrowers. These loans could be for anything from mortgages, car loans, to personal loans or business loans. Here's how it works. Banks pay you a small amount of interest on your savings, let's say 1% per year. But when they lend out that same money, they charge borrowers a higher interest rate. For example, a car loan might have an interest rate of 5% or higher, depending on the customer's creditworthiness. The difference between the interest banks pay you and the interest they charge borrowers is what we call the interest rate spread. This spread is the bank's primary way of making money. 2. Credit cards and fees. Credit cards are another major revenue source for banks. When you use a credit card and carry a balance, the bank charges interest on that balance, often upwards of 15 to 20% annually. If you don't pay off your balance in full by the due date, you're paying high interest fees. In addition to the interest, banks also charge annual fees, late payment fees, and foreign transaction fees. These fees are often hidden or overlooked, but they add up to billions of dollars in revenue for the banking industry. 3. Fees on transactions and services. Banks charge a variety of fees for everyday services. If you've ever paid an overdraft fee for spending more than you had in your account, or a maintenance fee just for having a checking account, you know what I'm talking about. Transaction fees are another way banks make money, like fees for using out-of-network ATMs, wire transfers, or processing checks. These fees may seem small individually, but in aggregate, they make up a significant portion of a bank's revenue. It's a way for banks to charge customers for services they use, especially when customers aren't aware of these hidden costs. You might be wondering, if banks make money through lending, fees, and interest rates, how do they pay their employees and cover their operating expenses? Well, just like any business, banks have to manage their costs to ensure they stay profitable. The key is understanding that the money banks make from interest rates, fees, and loans isn't just for making profit. It's also reinvested into the bank's operations. 1. Employee salaries and benefits. Banks employ thousands of people, ranging from tellers and customer service representatives to financial analysts, loan officers, and managers. They offer competitive salaries to attract top talent, especially in the highly competitive financial industry. How do they afford these salaries? Well, it's the profits generated from lending activities, investment products, and fees that cover payroll. For example, a bank may generate substantial income from issuing mortgages or personal loans. After paying off operating expenses, including staff salaries, the bank can reinvest any remaining profit into expanding services, technology, or offering better rates to customers. 2. Operational costs. Running a bank isn't cheap. Banks have to cover various operational costs, including maintaining physical branches, paying for technological infrastructure, securing data, marketing, insurance, and compliance with regulations. Modern banks have embraced technology, and many have shifted to digital-only or online banking models. Digital-only banks, or neobanks, can keep operational costs down significantly because they don't have to run large branch networks. But traditional banks still rely on branches and ATMs, which incur high costs. Banks also spend a significant amount on security and fraud prevention. They use advanced encryption technology to protect your money and data, which is another cost that needs to be covered by the bank's income. Now that we know how banks make money, let's talk about the functions they perform. Banks do a lot more than just hold your money. They actually keep the whole financial system running smoothly. So, let's look at some of the most important functions of a bank. 1. Deposits and savings. When you deposit money into a bank account, the bank is able to use that money in different ways. Sure, it's there when you need it, but banks also take some of that money and lend it to other people. The money you deposit in your savings or checking account doesn't just sit idle. It gets circulated in the economy through loans. For example, when you put $1,000 into a savings account, the bank might lend out $800 of it to someone who wants to buy a car, and they'll hold the remaining $200 as reserves. By doing this, they can support the economy by helping others achieve their financial goals, while also ensuring you can withdraw your money whenever you need it. 2. Lending and credit. One of the most important functions of a bank is lending money to individuals and businesses. This is how most people get mortgages to buy homes, how small businesses get loans to expand, and how entrepreneurs get the capital they need to start a new business. Banks act as the middleman in this process. They use the money deposited by savers to fund loans. Banks assess the risk involved in lending money by looking at factors like your credit score, income, and debt levels. If you have a good credit history and a stable income, you're more likely to be approved for a loan. The interest you pay on the loan helps the bank make a profit. Let's say you take out a $10,000 car loan at 7% interest. Over time, you'll pay back the $10,000 plus $700 in interest, which is how the bank profits from lending. The higher the interest rate, the more the bank earns. That's why some loans, like credit cards, have much higher interest rates than others, like mortgages. 3. Investment services. Banks don't just make money through deposits and loans. They also provide investment opportunities. You might have a retirement account or mutual fund managed by your bank, for example. When you invest in a fund, the bank takes your money and combines it with other investors' money to buy a variety of assets like stocks, bonds, and real estate. The goal is to earn a return on your investment. But the bank doesn't do this for free. They charge you a management fee. For larger institutions, banks also help companies raise money by issuing bonds or stocks. They act as intermediaries between investors and businesses, helping businesses raise capital for expansion or new projects. 4. Payment systems. Banks also facilitate the smooth transfer of money between accounts. Whenever you send money via wire transfer, use your debit card, or make an online payment, your bank is involved in the transaction. Banks ensure that money flows securely and efficiently between accounts. Take, for example, a payment you might make online. When you make a purchase, the bank verifies that you have enough money in your account, and they transfer the funds from your account to the seller's account. This system of electronic payments is essential in today's digital world, where most transactions happen online or through mobile apps. Banks don't just work behind the scenes with your deposits and loans. They're central to the overall health of the economy. Let's take a look at the crucial role they play. 1. Providing credit and loans. The most obvious role of banks is lending money. When banks provide loans, whether to individuals for a home mortgage or to businesses for expansion, they are injecting capital into the economy. Businesses use bank loans to create jobs, buy inventory, and expand operations. This keeps the wheels of the economy turning, providing opportunities for people and organizations to grow. 2. Promoting economic growth. By facilitating the flow of money, banks contribute directly to economic growth. They help businesses access the capital they need to invest in new projects, new products, and innovation. When businesses thrive, they hire more employees, pay higher wages, and invest in new technologies, leading to an overall increase in national income. 3. Supporting investments and savings. Banks also provide a platform for saving and investing. Through savings accounts, retirement plans, and investment products, banks help individuals grow their wealth over time. They offer various financial products that allow individuals to earn interest, dividends, and capital gains. For example, a person might use a savings account to store money for an emergency fund, or they might use an investment account to purchase stocks and bonds. Banks also provide a safe and secure place for people to save their money. Without banks, people would be forced to rely on physical cash or other less secure forms of savings, which could lead to financial instability. Now that we understand how banks work and how they make money, it's time to talk about the reality of banks, the side of the banking system that often goes unnoticed. 1. Profit over people. One uncomfortable truth is that banks are profit-driven organizations. While they provide valuable services, many people feel that banks sometimes prioritize profits over their customers. For example, high interest rates on credit cards or loan products can trap low-income borrowers in debt cycles. Fees for basic services, especially for those living paycheck to paycheck, can be a financial burden. 2. Too big to fail. In recent decades, we've heard a lot about the concept of too big to fail. This refers to large financial institutions that are so integral to the economy that if they collapse, it could trigger a broader economic crisis. The 2008 financial crisis was a prime example of this. Large banks took risky bets in the housing market and required government bailouts to stay afloat. This brings up important questions about whether banks should be allowed to take such risks and whether they should be bailed out using taxpayer money. 3. Financial exclusion. Not everyone has access to banking services. There are millions of people around the world who don't have access to a basic checking or savings account. This phenomenon, known as financial exclusion, creates inequalities in access to capital, credit, and financial security. Banks often set stringent requirements for opening accounts or obtaining loans, leaving some individuals and communities without the ability to participate in the formal economy. So, what does the future of banking look like? Well, there are a few key trends to watch. Digital banking. More and more people are turning to online-only banks, neobanks, that offer fewer fees and more flexibility. These banks use technology to offer faster services with lower overhead costs. Cryptocurrency and blockchain. As digital currencies like Bitcoin gain traction, the role of traditional banks in financial transactions may change. Blockchain technology, which underpins cryptocurrency, has the potential to disrupt banking by enabling secure, transparent transactions without the need for intermediaries. Financial inclusion. Technology may also play a role in reducing financial exclusion by making banking services more accessible to underserved populations. And that's a wrap on our deep dive into how banks work. From how they make money with loans and fees, to how they support the economy and pay their employees, banks are far more complex than we give them credit for. While they offer essential services, they also face challenges, from the profit-driven nature of the business to issues of financial inclusion. I hope this video gave you a clearer understanding of the banking world. Remember, the next time you walk into a bank or check your account balance, you'll know exactly how it all works behind the scenes. If you enjoyed this video, don't forget to like, share, and subscribe to Next Millionaire for more insights into the world of money, business, and investing. Until next time, keep learning, stay curious, and take control of your financial future.